particularly amazing about the Future Generation model is that it's delivering returns not only for shareholders, but also for really high impact charities across Australia.
Future Generation has allowed me to be the first person in my family to walk away from university with a degree, completely changed my life, my career path, everything. I now work in banking. I now have younger siblings and younger cousins and a younger family that are able to see that anything in life is possible.
The Future Generation's investment in us means the world to us. It means that we can sustain our services, reduce our waiting lists. We've even been able to open another office and therapy service down in Broadmeadows in Victoria.
Future Generation is unique. I get most of my money from government. Historically, it's slow, it's laborious, it's late. It doesn't change much. We need people who invest in the future. Future Generation has made a critical decision. Australia's social and economic future depends on investing in young people.
Future Generation has sparked an immeasurable and very tangible impact at Raise Foundation over the last 5 years. Back in 2014, we only had 309 young people in our mentoring programs, and we were raising just under $500K in revenue at that time. Roll on to 5 years later, and we have 1,027 young people in our programs this year alone, and we're in 6 states. So that trust that Future Generation put in to Raise over the last 5 years has meant that we've been able to make such a big difference for young people in Australia.
Future Generation is special because it not only provides a significant investment opportunity, it also provides the generous provision of philanthropic giving that has a significant impact on the lives of young Australians who are struggling with their mental health.
With Future Generation funding, it's an amazing long-term partnership because we have a 70 to 80% success rate at ending homelessness for young people, and Future Generation's investment is directly into that outcome. So for every dollar that comes in, it's feeding into ending homelessness for young people, and it's a larger problem than people understand, but Future Generation investors are making a difference in that area.
The Future Generation investment means an awful lot to our organisation, but I know for the community at large it makes an enormous difference for sufferers on a day-to-day basis.
Future Generation is just a wonderful model because it's providing great funding for a variety of charities, including my charity, and the fact that these funds are recurring each year just adds to the vital outcomes that we're all looking for. And the longer that we can help children, in my particular case, with our music programs, it's an absolute godsend.
We are all in this together. We're all in this together. We are all in this together. We are all in this together.
Good afternoon, ladies and gentlemen, and welcome to the update presentation on the Future Generation companies, FGX and FGG. For those of you that I don't know, I'm Louise Walsh and I'm the CEO of those companies. Sorry we're a little bit late starting, but I'm sure those of you that were here earlier would have very much enjoyed the buy, sell, hold segment that's new to the WAM Roadshow. This afternoon, Geoff Wilson, the founder of the two companies, will give us a quick update on the investment returns. I'll then give you an update on the social returns for both of the companies, and then we're going to have a panel session with a couple of our fund managers and also a couple of our charities. Those fund managers who'll be presenting on stage are Matt Hulp from Wilson Asset Management, one of our FGX fund managers, Nick Griffin from Munro Partners, one of our FGG fund managers, and our two charity representatives, Melissa Keller-Tuberg from Butterfly Foundation for Eating Disorders, one of our FGG charities, and Councillor Beverly Pinder, who's representing Lighthouse Foundation, one of our much-loved FGX charities. And then at the end, we'll have time for questions. We'll then give you lunch, and then hopefully you'll all stay on for the investment forum as well, which will immediately follow a lunch. So how many people are not so familiar with FGX and FGG and are not shareholders? Can I have people raise their hands? Great. Well, look, what we might do is just spend a few minutes with me giving you a little bit of an overview background on the companies. These two companies are listed investment companies, and Geoff Wilson founded them. He happened to be in London about 7 or 8 years ago, and he was sitting in a hotel reading the Financial Times, and he read about an investment vehicle in London that he thought, wow, this is something I really would like to bring to Australia. So that's actually what happened. Geoff actually quizzed the gentleman in the UK and decided that he wanted to set up something similar here. What we've done is we've chosen for both companies, for FGX, which is for investors that want to invest in Australian equities, and for FGG, which is for investors that want to invest in global equities, what we've done is chosen the best performing boutique fund managers that we could find in Australia and globally. And we've asked those managers to manage money for us in typically their main fund without charging any fees. So without charging any performance fees and without charging any management fees. And the reason those fund managers have said yes, which is very generous of them, is that both companies donate 1% of their assets each year to charity. FGX supports children and youth at risk charities, and FGG supports youth mental health charities. Today, we have about 15,000 shareholders, and FGX was set up and listed in 2014. And at that time, Geoff thought he might raise 20 or 50 million, and 200 million was raised. It was very successful. And based on the success of that IPO, a lot of investors said to us, we're quite underweight in global equities, would you consider doing a global equivalent? And FGG was born and listed a year later in September 15. Today, the assets of both companies are just over $1 billion, and we started with basically half that 4 and 5 years ago. The average shareholder is a self-managed super fund. That's about 50% of our shareholder base. 30% of the shareholders are ultra-high net worth families, family offices, large philanthropic foundations, and also large charities. That's 30% of the shareholder base, and 20% of the shareholder base are mum and dad investors. My mother, who's 85 and lives on the south coast of New South Wales, is a great example of a mum and dad investor. What she's done is bought small parcels of shares in both companies for each of her grandkids. She wants to teach them about capitalism and getting a dividend and investing, but she loves the fact that 1% of the assets are donated to charity. She also loves the fact that each August, our shareholders, no matter how big or small, have a chance and have a say and vote on where the 1% donation goes. So what she does is sit down with her grandkids and they go through and learn about what each of the charities have done with the donations and what they're intending to do with the donations. We like to describe them as a win-win-win, these three companies. Certainly a win for our investors, because the investor is getting exposure to the best boutique managers that we can find. And in a lot of cases, these funds are also closed. But also, the other win is that the investor is not paying a performance fee, and instead of paying what typically is a 1% management fee, we actually donate the 1% to charity. The charities who benefit, it's an absolute win for them. It provides them with an increasing stream of donations, but they have to perform to continue to be a charity, of course, as well. Lastly, the fund managers, they love being involved. It's a fantastic way and a unique opportunity for them to give back and make a contribution to the community or the non-profit sector. So that's just a bit of an overview for those of you that are not so familiar with the companies. What I might do now is ask Geoff to come to the stage, and he's the founder, as I said earlier. He's also a board director of both companies. He chairs the investment committee of FGX, and he's on the investment committee of FGG. So here's an update on the investment returns. Thanks, Geoff.
Look, thank you very much, Louise, and thank you as shareholders, and we're here to report to you. You own the company. And also, I can't thank the fund managers enough, because it's their incredible generosity that's allowed this to occur. In terms of the slide I've got up here, let's look at the performance. So we'll look at the first box. We've got FGX, which is the Australian listed investment company. Since inception, it's 9.5% is the per annum return before taxes and fees. And this is a listed investment company, so the taxes are paid by the company and it pays out fully franked dividends. but it's 9.5% return against the All Ords over that period of 8.2. And so you've got to remember, we've got boards on both these companies, and also we've got investment committee members on both companies. And personally, I'd like to also thank the investment committee members, because they are people with incredible experience in the of selecting fund managers in the Australian and global markets, and they all do that work on a pro bono basis. And what those investment committees are trying to do in terms of they're trying to put together a portfolio that we as shareholders can buy shares into these companies and get exposure to the best boutique fund managers in Australia and globally. And the reason why it's boutique fund managers is because history shows that the boutique fund managers tend to outperform the other active fund managers. You know, Tony Boyd, who writes Chanticleer in the Financial Review, about a year and a half ago did a great piece showing how boutique fund managers outperformed over time. And with these, with the boutique fund managers, effectively what the investment committee is trying to do is, we all know that the market performs over time, grows at about 10% per annum, but it is very volatile. And the investment committees have tried to put together these managers so it reduces the volatility of the performance. So say the market does that, the investment committees are trying to give you less volatility and give you at least the market performance, if not better. So as an investor, that's effectively what you want. And broadly, half the money in both of the funds are given to managers that are totally putting 90 to 100% of their money in the markets, and the other half is given to another group of fund managers, which we call sort of more absolute fund managers that can have high levels of cash if they want to be a bit more defensive. Now, in terms of going back to the performance slide, you'll see with FGX has given you 9.5% return per annum against the market 8.2%, which you'd be pleased with. Now, the next slide heading across is volatility. And you see the FGX's volatility, and that's really, volatility is a measure of risk when you're investing. And to give you an idea, like when you put your money in the bank, well, assuming the bank doesn't go under, but which it doesn't, but there's not much volatility, obviously, in your returns. And so there you're not taking much risk, and then you actually don't get much of a return. If you put your money in the equity market, there's more risk, there's more volatility, and you get a higher return. And going back to the slide, you'll see there, like the All Ords, over the period of time that FGX has been going, the volatility, or effectively the measure of risk, is 10.8%. So it's been jumping around quite a bit. And you'll see the FGX performance is 7.4%. So it's given you, broadly, it's got 70% of the volatility of the market as FGX. So if it's broadly 70% of the volatility of the market, then in theory, you'd assume you'll get 70% of the return. So in 70% of the return, go back to the first slide, the performance, the All Ords did about 8.2%. So you'd be getting a little over 5.6%. But the actual managers delivered 9.5%. So it was a very good performance from the FGX managers. If you look down at FGG, if we look at the volatility slide, the global index, you'll see there over the period of time FGX was operating, had a volatility of about 10%, and FGG, the portfolio, was 83% of that, or 8.3%. So then you'd expect that it would give you 83% of the performance of the market, which was, come back to the performance slide, 10.6, but it actually delivered you 9.2. So it actually was a better return. Both with FGG, like as the investment committees, we are not satisfied with those numbers. We'd like the volatility to be less, and we'd like the return to be greater. And the reason, in the early days, me sitting on the investment committee, I'm aware of that. We made a mistake. We actually put some money, it's global fund managers. We actually specifically put some money with various managers in their Asian funds. There was 5 managers that we took direct exposure into Asia. Now, with Asia, in theory, it's higher growth, higher risk, higher returns. And over the early part of the, over the first year, we realised we'd made an error, and so we withdrew from those 5 fund managers and just gave that money back to the global managers, and then they decided how they asset allocated. So that was why the volatility was a little higher in the early days, and also the performance. It impacted the performance. If we look at the next slide, is the pre-tax NTA. Now that is broadly, these are listed investment companies, and that is broadly what they're worth. If we sold all the assets, then broadly you're going to get a figure for FGX about $1.26 and FGG about $1.40. Now currently, as someone said to me the other day, they said, isn't it like when Coles sends you out the email, these things are on special? Because you can buy FGX below what it's worth and you can buy FGG below what it's worth. They have traded at premiums to NTA historically, go back 6 or 7 months ago. Why are they trading at slight discounts now? Is because, my view is we raised money a year or so ago for both of the entities. We raised it for people that we believe were long-term holders. Obviously, some of those, for various reasons, have decided to sell. And then it just takes a little bit of time to tighten that share register up, to get the people that understand what's happening with the companies and to be medium long-term supporters. And then those share prices will move back to around NTA, and both FGX and FGG were trading at premiums to NTA over 12 months ago. So that's just a matter of time. We have a detailed strategy that we use on that, and that's Louise with her team working through that at the moment. In terms of the fully franked dividends, FGX is invest with Australian fund managers to get fully franked dividends from their investments, and they distribute to FGX, and so the dividend for the Australian one will always be higher than the global one. You'll see there the last 12 months is 4.8 cents per share fully franked, and there's about in the reserve there's nearly 2 years of dividends in the reserve there, and in FGG, because we've given the money to global fund managers that a lot of them use offshore global structures, and they don't have to distribute, and of course they don't get the fully franked dividends flowing through either. So the yield or the dividend will always be smaller and just paid once a year, where the FGX dividend is paid each 6 months. So that's my part of the presentation. I'd now like to pass back to Louise. Thank you.
Thank you very much, Geoff. And just changing now and just having a little look at the social returns, the other side of the business. So it is quite amazing that just in 5 years, the donation or the investment in the charitable sector is $30.6 million in just 5 years. This year alone, we've recently donated or invested in the charitable sector in our 2 cause areas, $9.5 million. Now, it is worth pointing out, of course, that the fees foregone well and truly outweigh the donation amount. You can see there $54 million for the fees foregone since inception, and in the past 12 months that figure is $12.8 million. We're pretty serious about the charitable side of the business. I mean, it's interesting, in May this year that we undertook a very major review of all the charities that we support, and we used an external provider. We'd probably only do that every 4 or 5 years. But it was really to run the fine-tooth comb over these charities to make sure that they're accountable, they're transparent, that we're sure that those charities can demonstrate the funding outcomes that we need them to demonstrate. So as a result of that review, we're actually exiting 2 charities out of FGX, 2 charities out of FGG. We're transferring 2 out of FGX into FGG because they're more focused on youth mental health. And we have 1 charity in each of the 2 companies that's under watch. So it's just good to be aware that that's happening. Now with FGG, we've chosen the cause area of youth mental health. We're particularly passionate about this cause area, and you're probably like myself in that it's affecting my family. I have two very close immediate family members, one suffering from bipolar and the other one suffers from severe anxiety. And the figures are quite staggering. When we chose this cause area back in 2014, we chose it because it was chronically underfunded by the private sector, by corporates and also by philanthropists and donors. But we also wanted to play a leadership role in encouraging more corporates and philanthropy and philanthropic dollars to flow into mental health, because it really is the health crisis of our time. I'm convinced about that, particularly with young people, and of course not just with young people. About 2 or 3 weeks ago, we actually released this report. We've actually got some copies that you can get, or you may have got when you came in or when you go out. But this is a report that we commissioned and did with EY. And we wanted to look at why mental health funding was so very low in the private sector. We've come up with 6 findings and 6 recommendations that we're now looking to act on. The reason we did this report is we did want to show some leadership, and we decided to do it at the start of this year. But we also wanted to really lift the brand awareness. This is such a good story about these two companies that we wanted to make sure that more people in the community knew about the investment opportunity and what we're doing with the future generation companies. And that's really what's happened. You know, we did some fantastic media a couple of weeks ago, radio, newspaper, print, podcasts, all sorts of things. And that means that more people in the community are now becoming aware of these companies. And of course, we're hoping that that will stimulate more buying, which of course will help us close the discount to net tangible assets. So that's another part of our communication strategy. But a main part of our strategy is actually to call the shareholder register. So if we have your phone number, what we're doing is calling you. And it's really about updating our shareholders, seeking feedback, but importantly also talking with them about the discounts and what we're doing to close the discounts, because as Geoff said, we are confident that we can close them. Now, what I would like to do before we start the panel is thank our fund managers. These are our 30-odd fund managers across the two companies that have very, very generously agreed to waive their normal fees. We can't thank these fund managers enough. And of course, you're going to hear from 2 of them this afternoon. These also are our designated charities. So these are the current 22 charities that we support across children and youth at risk and also youth mental health. These charities, of course, could change over time as we grow bigger as well. The plan is to take these companies to 3 billion assets by 2027, which of course could mean that the donation will be a staggering $30 million just for that single year. Our service providers, we also want to thank them. These are the businesses that are working tirelessly behind the scenes to make sure that we keep the costs of the companies right down. I'm the single biggest cost of both companies. And businesses like Mertens, I think, who are here today, they're our company secretary. They do all our work pro bono. The ASX, they waive our annual listing fees. ComSec, they refund brokerage fees. So if you buy shares in FGX or FGG or both, you pay the brokerage fee, but they do refund it. But I have to single out Wilson Asset Management because their generosity is quite incredible. Geoff and Kate Thorley, the CEO, there's about 35 staff at WAM headquartered in Sydney, and half of those staff actually work on the future generation companies, and varying degrees of their time. At one extreme, I have 2 full-time finance managers who manage all the finances for the future generation companies. They sit in the finance team of WAM, and WAM actually pays that salary or that package of those 2 people. So the future generation companies are very much part of the DNA of Wilson Asset Management. So now what I'd like to do is call up our panellists. We've got some chairs coming up. So our 4 panellists, if you could please come up and join us. So it's Nick, Matt, Melissa, and Beverly. And while we do that, I just want to also mention that immediately following lunch, so we'll break for half an hour lunch at 1:15, at 1:45, we will be hosting our 6th investment forum. So this is a fantastic opportunity to hear from our very best fund managers. We've handpicked six of them, and in fact you'll hear from Nick and Matt as part of that. Each of those fund managers for 5 minutes each are going to present a stock pick idea or an investment idea. We've also got an amazing panel happening with James Thompson from the Financial Review, and he'll be interviewing Peter Cooper from Cooper Investors and also Paul Bassett from Square Peg Investors Capital. So I'm hoping you can stay for that, 1:45 to 3:15. So now we will have our panel. I'm just going to grab my notes. We don't have Matt yet, but I'm sure someone's going to get Matt for us. But I think what we'll do is we'll start without him. So I might start with you, Nick, first. The first question is, can you give us your view on the market? Thanks.
Oh, okay, the all-important view on the market. So I think it's important to remember the lesson we learned in 2019, which is that interest rates conquer all. So that a lot of bad things happened in 2019, but the market still went up. And it went up because interest rates got lowered to a very, very low rate. And so when you think about the interest rates that you can get by putting money in the bank, the alternative to investing in equities is clearly there. And that helped the market slide through 2019. As we look through into 2020, it's probably clear from here that probably less bad things are going to happen. Ultimately, we'll get some sort of a trade deal. Economic growth probably can't get much worse than it was in 2019, so you'll start to cycle these really bad numbers. And on top of that, a lot of that stimulus that went into the market will come into the market, so you'll get better growth in 2020. The last thing is you'll probably get Brexit and these other things solved. And so, but the interest rates will stay low. So our view would be that the first half still looks pretty good, and you can see that in the way the market's performing into the back end of 2019. Usually means the first half of next year is going to be quite good. And then you'll run into the issue of potentially higher interest rates and a US election. And that'll create more uncertainty again, and we'll be back into that sort of washing machine we spent the first half of 2019 stuck in.
Great. All right. And what about, can you give us a couple of stock pick ideas? I know you're up later, but if you've got one or two that you want to reveal, which is not one of your stock picks this afternoon.
No, I understand. Okay, so I got to give you two stock picks. So ultimately, remember that it's important to remember that the equity market is just this big group of stocks, right? It's not a stock market, it's a market of stocks. And there's always lots of cool things happening, lots of exciting things to invest in. And I sat in your buy, hold, sell session before, and I heard lots of really good ideas. And so it's clearly quite let's just say the risk appetite in the room is slightly higher than I thought it was, by at least the stocks I heard about. And so one gentleman in the back left, actually, and so the couple of stocks I'm going to give you are slightly more speculative. You should always, if you're going to invest in international shares, you should always own Google, you should always own Amazon, you should always own Alibaba, you should always own Microsoft. Those are your core holdings globally. But the speculative ones I'm going to give you, someone in the back left actually mentioned it. It's a company called Keysight Technologies. And since he mentioned it, I'll mention it because it is in our fund. And it's basically leveraged to the 5G expansion. So one of the big things that's going to happen in 2020 is 5G is going to roll out. By the end of next year, you're going to buy your first 5G phone. And as that happens, this company tests equipment for 5G. So it's leveraged to that trend. And then it's also important to remember that 5G is going to be great because everything's going to be connected. So your car's going to be connected, your fridge is going to be connected, your front door is going to be connected, your office is going to be connected. And so it does the testing. So it's a sort of an Internet of Things place. So this proliferation is going to go everywhere, not just phones. So that's Keysight Technologies. That's the first one. Have I got time for a second one?
Yeah, go for the second one, absolutely.
And so the second big thing that's going to happen next year, and maybe people don't believe this, but we do, is the electric car things we're going to really start to kick in next year. And so you're looking at sort of 1% to 2% of all vehicles today, but it's rapidly going to move towards 20% over time. Why? Because the cost is going down, and it's quite frankly a better product for anyone who's actually driven one. The company I'm going to give you is a company in Germany called Infineon Technologies. It's again another semiconductor play because I remember the room's quite speculative from what I gather. And Infineon makes power semis. So they basically make a semiconductor that any electrical engine in the world takes power and has to turn it, it has battery power and turns it into power to drive a drivetrain. So an Infineon chip is basically in every single electric powered product on the planet, whether it's a car, a scooter, a bus, etc. It's not a very big company. It's about $25 billion in Germany. Both the stocks I gave you trade at around 20 times PE, so they're not expensive. And we think they look really good for years and years ahead.
Great, thank you. Now, Matt,
yes.
I know you're just having a little breather.
Yes.
So can you give us your view on the market? Be great.
Yeah, it's probably the view on the market is really, at the moment, it's very liquidity driven and cost of funds driven. So that is supporting asset prices, so equity markets are going up. And we're going up on the anticipation of a relief on trade as well. So at the moment, heightened uncertainty, predominantly around the China and US trade conflict. We keep getting rumours, I think, for the last 3 months that, the trade deal, the first phase is very close. It's very elusive. We haven't received that yet, but it appears the dialogue and the narrative is changing. We will get a phase one. So you'll get some relief there. What we're really hoping for to see is some economic improvement and economic growth return in 2020. We need that to support the asset prices where they are, because liquidity can only drive it so much higher from here. So for us, we really want to see that economic activity come through, and we think it will come through in 2020. So watching that very closely.
Great. And how about a couple of stock picks, or at least one? I know not the one you're doing this afternoon.
Okay.
Yeah, so don't reveal that. But if there's anything else you want to...
Well, I might leverage off the EV theme.
Go for it.
So part of the lithium batteries, you need nickel, and EV vehicles need a lot of copper too. So for us, we've been really positive on nickel for a period, predominantly through increased usage over time, because it was used for stainless steel production, but now obviously a new use and growing. So over time, nickel for us looks very attractive as a commodity, and the way we've been playing it through companies we invest in the ASX is through Western Areas. Independence Group has got a bit of gold too, and at the speculative end there's some small ones like Mincor, and BHP obviously with Nickel West too. So for us, Western Areas looks good. You've got Indonesia, which are banning exports at the moment, so that's really tightening the nickel market. It's come off recently because Indonesia keep delaying the ban date. They said it was going to be effective immediately, then they were allowing some to be exported, and then they said January 2020. So that will tighten up. So nickel for us in the long term looks good, and that's the way we're playing it through Western Areas and independence. And we think there'll be consolidation. It makes sense for someone to consolidate this sector. And even speaking to companies like Wesfarmers, they want to play in this space too. So they obviously had a crack at Linus. They've bought Kidman. Wesfarmers want to be like a chemical, they want to be the medium between the car manufacturer and the miner. So they're investing a lot of money in trying to find companies to invest in and build that. So for us, consolidation happens. Nickel West, Western Areas, independence, I don't know how it plays out, but something will happen there in our view. So for that, on the EV theme, we're quite positive on nickel and also copper as well, because the copper intensity of an electric vehicle is a lot higher than a normal internal combustion vehicle. So for us, copper looks pretty good on that thematic too. And the way we play that is through Oz Minerals. And Oz Minerals, obviously, copper is a proxy for global growth. So we do get global growth next year. You've probably got a couple of thematics playing out for Oz Minerals as well.
Great. Thanks, Matt. Now, Nick, what about what's in store for 2020? Any particular themes that you pursuing see coming through?
Yeah, so again, hopefully the right room to talk to this about. But so from our point of view, we generally try to, so we're a global growth fund, so we're trying to find structural growth trends in the world to invest in. We talked about 5G and we talked about electric cars, but to be fair, we came up with those sort of a year or two ago. Our next one for this next year is unfortunately is climate change. This is going to happen. And we see a profound change in attitudes this time, and you don't have to rely on the government to solve energy independence. You can rely on a corporate, because the corporate's going to do it because their stakeholders want you to. So every single company meeting I go to, the company is committing to being carbon neutral. Whether it's Starbucks, Walmart, Salesforce, Google, Facebook, and they're building their own wind generation. They would do their own wind generation electricity plants. They're building their own solar plants. They're doing their own insulation around a building to do very smart buildings to do less energy. Packaging is a massive theme for us at the moment. These are all things, because you get single-use plastics are going to be banned, and this is going to accelerate at a very rapid rate next year. And so that's really where we're trying to plug our money for next year, because the 5G and the car ones were sort of a year or two ago. They're still going to work, but they're well appreciated. Our job is to find the one that's not completely appreciated yet, so that's where we're looking.
Great, thank you very much. And Matt, different question for you. Like, obviously summer's coming up, holidays. Any particular books you'll be reading or anything you'd recommend that people think about buying for the summer break?
The ones I might recommend would probably bore everyone. They're all around macroeconomics. So if you want to fall asleep, I'll recommend a few of those. But what am I reading at the moment? Yeah, they're all very textbook focused at the moment because
bit dry.
Bit dry. So I'm trying to think on the spot what's an entertaining read. One of them is more entertaining, is Geniuses That Fail, the LCTM failure, LTCM. That was around these very smart guys that got very confident in their models, and then some circumstances changed in the market, a few one-off events, and they basically went under and almost brought the whole financial system down with them. So it's a bit of an entertaining thing. There's a couple of Nobel Prize winners, so when you get stocks wrong, don't worry, there's Nobel Prize winners that also blow up funds. So it's quite a hard art. And when you get over, I guess the takeout is when you get overconfident, that is when you get yourself into trouble. And they sort of double down on their positions over time, and that's how they blew themselves up. So Geniuses That Failed is a good read.
Geniuses That Fail. Right, okay, thank you. Thanks very much, Matt. Well, look, what we might do before we break for some questions is talk to our two charity representatives. So firstly, I want to have a chat to Beverly, who is a City of Melbourne councillor. She also chairs the Homelessness Advisory Committee for the City of Melbourne. And when I read up your bio, I discovered, I hope I'm allowed to say this, but she's a former Miss Universe Australia.
Oh, God.
So there you go.
40 years ago.
Yeah, doesn't matter. Looks good. And she's also a supporter of Lighthouse. But Beverly, can you talk to us a little bit about, I suppose first up, what Lighthouse does and also how you became involved?
So I guess Lighthouse, I mean, I've known Susan Barton, our former Melburnian of the Year, sitting right over there, a wonderful woman. And one of the first stories I heard from Susan was, she was in Sri Lanka, the country where I was born, and she had a baby in her arms, a foster care baby, and the baby died. And that was a real changing moment for her. She came back to Australia and threw in her corporate role and started helping vulnerable kids. 30 years ago, Lighthouse Foundation was founded by her. It's their greatest asset is their therapeutic model of care. It's applauded throughout Australia, governments and philanthropists alike. And it is very simple. It is returning the home life to children. So for youth in a home with 2 live-in carers, all of the therapy, the counselling, schooling, all of the guidance that you would expect as a child to get from a family unit is that which Lighthouse provides. And it brings tears to my eyes. In fact, the Bardas family, some years ago, I went to them for funding to open a home in Kensington. And generously, David and the late Sandra Bardas, of course, provided funding for that home. So it is costly to run a home like that. But what it does for me, Louise, is that I'm working quite frantically on this homelessness portfolio at Town Hall. But I'm a strong believer that the preemptive stuff is what's so important. That's what Lighthouse does. It's those kids who are neglected, they're abused, they've got nowhere to go. Their mind is, it's been stretched to all edges, and it just needs to bring back that elasticity, that care, and ultimately love that a family provides. So this really is Lighthouse's Foundation is very, very close to my heart. I call myself a friend of the Lighthouse Foundation. I used to be on the subcommittee for fundraising, but essentially it's homes in various locations. I can't tell you the number we have, or they have currently, but it's homes, it's 2 living carers, it's for youth, 15 to 22 years of age, and it is to prevent them from becoming homeless. And it is also teenagers who are pregnant. So the Mums and Bubs program is superb. And the next model that's on the table, which I met with the Minister Donnellan and with Susan this week, is about the foster care model. And we need something like 3,000 foster carers, and there's a dearth of them. So this is like a hub concept that will really instill that care for not only the child but also the carer. So that's what we're aiming for in the mid to long term.
Great.
Yeah.
And just out of interest, I mean, with your committee hat on for the City of Melbourne, I mean, it strikes me, it's interesting when I look at some of the numbers with homelessness. Now, I'm based in Sydney, so I'm not sure of what the numbers are in Melbourne, but the numbers are not that dramatically big compared to some other issues, in the community. And that's what sort of staggers me about, you think to yourself, surely we can solve this one. Can you comment on that? Because I'm not sure how big an issue it is in Melbourne, but any comment on that?
So 24,000 homeless in Victoria. In Melbourne, our last street count, which we did in June 19 last year, freezing cold morning, 3 a.m. I was up, we counted 279 sleeping on our streets, but that didn't count those sleeping in cars, those in parks, those in derelict buildings, because naturally, for our safety, we didn't go in. So 279, and then our inner metropolitan areas, there's another 50 or 60 or 90. So the numbers are not that big in the central city, but it's also about returning people to their place of origin, and that's where we're collaborating with the other city councils and other councils and trying to kind of place people, find homes first. The state government has come through with if we, the City of Melbourne, can find with other councils, find places, then the state government will actually provide all of the services, because there's no point giving someone a room. You've got to actually have the wraparound services. Currently at Town Hall, the Homelessness Advisory Committee has 10 people on it. 5 of them have lived experience, and those 5 have become good friends of mine. I love them, and I learn a lot because I've got the experience from the Lighthouse Foundation as well. And I think it's that healing and that care and really getting people to a place where they're not afraid anymore. They're not afraid to even go out, maybe don a suit from fitted for work and go to a job interview. I think that's the long stretch goal, placing people. And I have homelessness in my family, so I know it very, very well. And that's why it resonates with me so much.
Fantastic.
Yeah.
I mean, one of the things we love about these 2 particular charities that we support, Lighthouse and Butterfly, is when we did the external review that I mentioned earlier in May, in fact, Butterfly was the top performing charity in FGG, and I think Lighthouse was maybe second, so maybe you weren't quite first, but you were close.
Yes, yeah.
But one of the things they rated so highly in is that they do demonstrate the outcomes and the impact of your work. And some charities, and some of you may well be involved in charities, one of the problems with a lot of them is that they're very good at telling you how many young people have been through a program. But what they're not so good at is actually tracking those young people long term so that we can actually see the outcomes over a period of time. And that's what's to be applauded about these 2, and I think you'd be aware.
And that's a very important point, Louise, because as a businesswoman, what attracts me mostly, of course, is that risk-based framework that it operates under, and the KPIs. So for each child, there's a set of KPIs. So when we return them back to community, when they're in community, they can actually come back to the home as well. That home is always theirs. So the KPIs for Lighthouse Foundation are very, very stringent, very strong, and it's delivering on its KPIs for each child. So that's great.
Fantastic. All right. Well, look, thanks, Beverly. And look, Beverly has been called to a important meeting. So when she slides off the stage at 1:10, you'll know why. It's not that she's bored with us or bored with you. It's just that she is going to be called away. But thank you. Okay, Melissa, you've been very patient over there. So I'd love you to tell us a bit about your story. Now, you're an ambassador for Butterfly Foundation for Eating Disorders. Can you tell us, a little bit about?
Yeah, sure. So I'm actually an example of what you guys were just talking about a young person who's been through an illness which is actually quite traumatic and really difficult to come through. And the Butterfly Foundation and what I've been involved with them has been my journey since then. So from an advocacy perspective, and I guess it all started with the idea, after having come through recovery from quite a severe eating disorder, is that my story was worth sharing. And I acknowledged that it was a difficult time, but I could also acknowledge that things could have been better. And when I talk about, what could have been better, I guess we all now acknowledge that youth mental health is quite a underfunded area, and there's a lot of places for reform, and my personal experience definitely speaks to that. So you can talk about increased support for regional areas in Australia, or early prevention, or for families and carers. But you can also talk about the positives as well, and that's something that I'm particularly passionate about. When we talk about storytelling, it's actually quite powerful, and in some of my work, I go to schools and I speak to young people in college age groups, so say between 16 and 18, and the responses that they have are really quite powerful, and it's as if mental health is often talked about in the news, and it's something that we acknowledge, every one of us, is a difficult issue, and something that there needs to be a lot of action on. But from a positive perspective, storytelling is great because it inspires young people. So it's not just something that they know about, but something that they want to do about. And that has so many multifaceted benefits. If you talk about early intervention, if there's any risk factors, but you also talk about the social and cultural features that are kind of the backdrop to an illness like an eating disorder. And that's something that I'm personally really passionate about, because once we acknowledge that there are cultural aspects, we also have to acknowledge that we all have a role to play, and we all have such a position of power to make a positive impact. So what I do with the Butterfly Foundation, since being through what I've been through, has been such a positive experience. Actually, I was on the phone to my mum last night, and it was really quite special because she was such an important figure during my illness. But also because upon reflection, I could now tell her that everything that I've experienced has only had positive benefits for me now. And I'd like to say, hopefully, positive benefits in the eating disorder community and the mental health community more generally.
So do you mind telling us a bit about your story, your personal story,
Yeah,
if it's not too difficult?
No.
It would be fascinating.
Yeah. I love talking about my story because it's empowering, and another reason why advocacy is great. I guess the way that I usually describe it is I say, well, it started off with a thought. The thought that if I could change this, or if I could tweak that, maybe I might start feeling a little bit better. And it's quite concerning to me now, I guess, because I realize that that's a thought that so many of us share. But for me, it grew into something much more serious. So it grew into forgetting really that there was people around me who loved me and supported me. And at the beginning stages of my illness, it was having the energy to run around in the fresh air at school, or to enjoy birthday parties with my friends, or going to the movies and eating popcorn. But it further along, obviously, if left untreated, eating disorders can develop into something quite serious. So my restrictive eating, it eventually took me out of school. So I had to go to hospital and be fed through a tube in my nose. Part of the aspects of treatment at that stage are also being in a wheelchair and living away from your family in a hospital for several weeks. I mean, for some people, even months, and in cities away from where they live from. It has really quite severe impact socially, financially, in every aspect, really. So it's a huge burden. But there's so much more positive things that happened from there because I'm so lucky that my family was so supportive. I remember when I was in hospital, because it was quite an intense experience, I suppose, one of the main motivations for me in recovery was being able to go home. But interestingly, and something that I'd like to share today is the motivation to go home is alone not enough for somebody going through an eating disorder, because once I was well enough to return back to the family setting, I realized that I was home and I wasn't yet well, because the recovery journey is so long, and just because somebody's maybe addressed some of their physical symptoms doesn't mean that there's not a lot of psychological work left to be done. So there's so much importance placed on outpatient therapy as well as the intensive care. So I could go on a little more
and
about my story.
what are you doing now? So are you studying or working or?
Yeah,
that'd
sure.
be great.
So now I am super glad and super proud that an eating disorder no longer has a grip on my life. It's amazing to think that, to me, saying yes to my body's needs is in a way saying yes to all of the things that I do and all of the things that life in the future will bring to me. And in that way, specifically, when I wake up in the morning, I study my psychology degree. I also do music, so I play the alto sax, and I'm involved in a whole bunch of volunteer roles with Origin, which is wonderful that you guys also support. But it's the eating disorder no longer has a grip on any of those decisions that I'm making, and I'm so passionate about making. And I guess that's...
Oh, that's fantastic.
Thank you.
Well, thank you very much for sharing the story, and we're delighted with Butterfly Foundation that what we're funding is a youth intensive outpatient program, and we heard about through Butterfly a program in Los Angeles that was custom made, and we knew some Australians were travelling to the UK, to Los Angeles with their families to benefit from the program. And I think it cost something like $150,000. Like, it is a very expensive program. So obviously not within the reach of most Australians who would suffer from eating disorders. So what we've done is we've actually seed funded the launch of that program in Australia. And we're delighted to be doing that program. And we're doing it at a youth level, as young as possible, so that we get in at that early intervention stage. And I know that one of the next things for Butterfly Foundation is they're looking at opening a residential centre on the Sunshine Coast in Queensland as well. So they're a fantastic organisation doing great things. And again, thank you very much, Melissa. So what we might do now, just with the final minutes, I think we've got 4 or 5 minutes left, so we get back on time, is if anyone has any questions.
Sunshine in my world. I do it all 'cause you're my queen.